Today's topic is going to be high-end homes, financing them, and why they're real tricky for us as mortgage brokers, often to get people the financing that they're looking for. The most misunderstood concept, and something that seems to bite high-end buyers in many occasions, is the concept of a sliding scale. Now, the way a sliding scale works is lenders, for the most part, don't run into a sliding scale with the average home. If you're purchasing something that's less than $750,000 as a purchase price, you probably have never run into this. You may never have even heard of it. However, for very high-end homes, and we're talking homes $3, $4, $5 million plus, this becomes a very real concern. So here's how a sliding scale works. I'm going to use one of the institutions, which would be a CIBC. They'll allow you to finance 80% of the first $750,000 of a purchase price of a property and 60% of the balance. So if you're looking at something that's $5 million, and you're thinking, well, you know, I don't want to have CMHC fees, so I'd like to put 20% down. When you go and look at that, 80% overall financing is not going to be available through that bank that has a sliding scale. This becomes really prevalent with institutions like HSBC, some of the credit unions, because they're smaller institutions. They're a little tighter in terms of what they'll accept, how much money they're going to lend on any one property. Some of them will only lend 80% of the first $500,000 and 50% of the balance. So if you imagine a $5 million home, some of the stuff in West Vancouver is way up there, or Point Grey. I've seen that properties are listed for $11 million, for $6 million. Look at a $5 million property. So they're going to give you 80% of the first $750,000 and only 50% of the balance. So you're going to have a down payment of upwards of $2.5 million. Now, the number of buyers that has that kind of money is not very high. Most people looking at those properties are trying to put maybe a block of 25 or 30% down. It is doable, but it's not doable through an institution with great bank rates across the board. Often what we end up having to do is to do whatever the maximum amount an institution is going to do. We'll do that with, I'm going to grab a bank here, grab it with a CIBC. We'll do that, then we have to get a second mortgage and top it up. And the second mortgage may be at higher rates and may have a little bit more punitive terms. But when you're dealing with ultra high-end real estate, the banks are going to be very conservative. And the reason is marketability. If you look at a high-end home during a market decline, it's very hard to move them. I would say impossible. During the slowdown that happened when the Lehman Brothers fell apart back in October of 2008 through maybe March of 2009, there was virtually no sales in these high-end homes. It made life very, very difficult for these sellers. There's one property one of my clients is looking at right now that was listed for $7 million, has come all the way down to $4 million. Now, if you think about that, that's only over a 1-year period of time. So a bank that loaned something in their sliding scale may have ended up underwater, even though they only gave a loan of 55% of the actual purchase price when that client purchased it. If you were somebody you know is looking at buying something that is ultra high-end, you've got to work with somebody who's used to dealing with it, who knows how sliding scales work, knows where exceptions can be gotten and where they can't be. I can help you with that. I'm Rowan Smith for the Mortgage Center.